Welcome to everyone tuning in today. Thank you for joining us. I'm Bryan Shipley, the co-CEO and Chief Investment Officer here at Arnerich Massena. We're a Portland-based investment advisory firm serving private clients, nonprofit endowments, and foundations. Today I'm joined by Arthur Coyne, Senior Analyst, to really kind of talk about some challenges that the U.S. faces from a budgetary standpoint going forward, as well as the impact of rising rates and how that's going to flow through into our economy. In a recent MarketCast, we actually showed a chart that kind of looks at projections over the next 20 or even 30 years and just some of the challenges that could be ahead of us. And we wanted to delve into those topics in a little bit more detail. Arthur, thank you for joining us today. Really glad that you're here to share some of your thoughts.
Well, thank you, Bryan, for having me here. This is such an interesting issue, and it's a very important issue for both citizens and for investors. And so we're going to share some interesting information about how this can play out and where the pain points are for our country. So why don't you start by explaining what you would describe the problem as?
So the problem is really huge, and it's not something that necessarily sneaks up on you. It just tends to be this growing tidal wave. But we've got lots of problems even in the short term as well. There's talk of a government shutdown at the end of this month. We're continuing to deal with the invasion of Ukraine, potential conflicts in and around China and Taiwan. Going back to shutdowns, we've actually been through these before. There's been multiple times, but we really haven't seen any major shutdowns. The first one was around 1996. We also saw shutdowns in 2013 and 2018. But the bigger issue that we're really kind of keying in on this podcast is the long-term debt burden. This rising tide of debt, choking off kind of the government's ability to sustain the economy and bleeding taxpayers of not only services, but just more and more dollars going to service that debt. So we've really kind of come to this place where economic growth has kept the debt manageable up until recently. So up on your screen should be a chart of U.S. government budget projections. In the 2000s, our debt grew a lot faster than our economy. And in the last 3 years, rising interest rates have caused our country's interest expense to nearly double. Today, $1 in $10 goes towards servicing that debt. The Government Accountability Office actually just gave a warning that the federal government faces an unsustainable long-term fiscal future. And we also saw Fitch downgrade the U.S. from a AAA rating to a AA plus rating. So what does that indication, that downgrade that Fitch provided, kind of tell us about what's happening in the U.S.?
Well, Fitch's downgrade said a few things. First, they said there's been a deterioration in the standards of governance, and I think that's critical. They point out that we've had political standoffs between the two parties over, raising the debt ceiling, and it's become kind of a dysfunctional situation. They also note that the United States has some fundamental issues. We have an aging population, and that's a demographic issue that's not going to go away on its own. And they expect that our fiscal situation to deteriorate over the next 3 years. And why 3 years? And I think it has a lot to do with the fact that our government, it has this burden of like $33 trillion of debt that it's carrying. And half of that debt, so $16 trillion, is going to need to be refinanced within the next 3 years.
Wow.
And so interest rates, 3 years ago were 1% or so, and now they're going to be refinancing this stuff at 4%.
Yeah.
And so the debt burden is going to be really painful. And adding to the bad news is the fact that since the government made its last projections and since Fitch did its downgrade, interest rates have risen by about 0.5%. Mm-hmm. So things are actually even worse now than they were at the time that they called the problem. Yeah. So, all this should be like a wake-up call for our government, which does not have its, financial house in order. Yeah. And our country faces some really difficult decisions, some trade-offs, and, how do you want to handle this? Do you want to have a recession with job losses, higher taxes, higher inflation, lower standard of living, devalued currency, or a financial crisis, or cuts in entitlement programs? Yeah. All of these kinds of bad things can come out of this bad situation, and I like to call it pick your poison. the government and the citizens are going to have to essentially pick what solution is the least painful solution. So that's the point we're at. But we've been in difficult situations before. This isn't the first time. Maybe we could take a look at how this compares with the past.
Yeah, so the next exhibit that we're showing really kind of looks at the last 100 years of government annual spending. Its receipts are kind of the tax revenue that's coming in from the citizens of the U.S. Net annual deficit, obviously a really important number. And these are all anchored to kind of a figure of GDP. And you can see how the government spending and deficits really kind of increased during periods of crisis. And boy, have we had our share of those more recently. But some of the first crisis was really around World War II in the 1940s. Then we had the global financial crisis of 2008, and then obviously COVID in 2020. Those were periods where the government really responded by taking on a lot of debt to hopefully stabilize the economy. We really ran kind of a balanced budget after World War II all the way through the 1960s, but then our approach really changed in the 1980s. We started cutting taxes. We started to run kind of annual deficits, and then we ran into the global financial crisis and began resorting to kind of really extreme levels of borrowing. So the philosophy really was, it's okay to borrow debt in times of stress. And things could have been worse if we didn't. Who would have known what could have happened during the GFC or even COVID if the Fed hadn't stepped in and did what it did? But the concern now is that our debt has really become so high that it's become this really major problem.
That's right. We have another chart which shows the annual deficit and then the total accumulated debt. And you can look back at the 1970s, and in the 1970s, we were running small annual deficits, but the total debt as a percentage of GDP stayed about the same. And that's because our GDP at the time was growing rapidly.
Yeah.
So we were able to have more and more debt, but the GDP was growing. So that ratio stayed pretty manageable through the 70s. But then something interesting happened in the global financial crisis of 2008, where the Fed cut interest rates dramatically down to zero.
Yeah.
And that enabled us to pile on a lot of new debt without having any problem paying the interest because the interest rate was zero, right? Or near zero anyway. And so that led to a situation where we added a lot of debt, but the debt and the debt to GDP ratio became a lot larger, right? But it wasn't painful, so we didn't feel it, and we didn't really notice it. But now you look at the end of 2022, we've been through the COVID crisis where we kind of did that again. We cut interest rates and we added even more debt. But now, we had a bout of inflation. We've raised the interest rates, and now the debt to GDP is becoming extremely painful. It's a lot like if you had a credit card and you had a large balance on it, but then they raise the interest rate on you when you have this large debt amount. It's super painful. So it puts us in a tough situation. Like a decade ago, the average interest rate that the government was paying on its debt was about 2%. And we went through a solid decade of about 2% interest rate across the board on average. But now that we're looking in the higher interest rate environment, the average is closer to 3, and it's on its way up to 4. And so as that old debt that was issued at 1% or 2% has to be refinanced at 3 or 4%, it becomes really painful. And we have another chart to show that. And you can see this line that goes back to the 1960s where back then we were paying like virtually $0 in interest on our debt as a country, and that figure grew, but then it really took a spike vertical up in this last year when those interest rates came up. And not only were we paying more on the existing debt that was rolling over, we've been adding new debt.
On more,
We've been adding new debt because our government budget has been out of balance. So there's those two pieces working against us. And so I would call this the key pain point. This chart is why it's a political issue right now, is because the actual dollars going out of the government's door have just gone through the roof, and it's not sustainable anymore. It used to be sustainable when we were funding this at 1% interest rate, but it's not sustainable now. And from a political standpoint, it's also a problem because taxpayers are paying taxes. They want to get services for their tax dollars, and they're not getting services. That money's just going out the door to pay interest.
Yeah.
So that's really a kind of an existential threat to our government itself, which raises the question, if a large and growing proportion of the taxes that are being spent are going to interest and not going to pay for real government services, where's that going to lead?
Yeah, and so it kind of brings us back to that initial chart that we showed that are the projections from the Congressional Budget Office. And again, it's looking at kind of historical averages. Where have we been from an interest expense, revenue, outlays, and then ultimately what is the annual deficit, and looking at over expectations over the next 30 years. You can see historically we've ran an annual deficit of about 3.7%. That's expected to grow to 10% over the next 30 years. So a massive increase there. Interest expenses, exactly what you were talking about, Arthur. Historically, about 1.8% of GDP. That's expected to more than triple to 6.7% of GDP over the next 30 years, and could be worse based on exactly the paradigm that you just laid out. So, I think our debt problem could lead to a number of different things. Number one, cutoff of government services. Obviously, that definitely impacts Americans across the board. Tax increases. No politician really wants to talk about that. Inflation, job losses. Capital flight. We've been in this really beneficial position of having the reserve currency across the globe. That could be at risk. And then finally, political turmoil. So it's important to provide some context around that too. So we're not alone in this by any stretch of the imagination. I think it figures coming up on your screen right now that there's a lot of other countries across the globe that have serious debt problems as well. And so it's worthwhile to spend some time kind of looking at who we're in the neighborhood with. So according to the IMF, which is the International Monetary Fund, the U.S. has the number 5 debt load across the globe. That's after Japan, Venezuela, Greece, and Italy. As a rule of thumb, any debt to GDP ratio that's north of 60% is considered a potential problem. And you can see we are well above those levels. But we are also pretty unique. We've got really advanced economic and military power that gives us some advantages relative to perhaps some of these other countries that we're being grouped with. The dominance of the U.S. dollar. And maybe we're able to carry a little bit more debt because of those positions of power. Japan, the world's most indebted nation, they've been holding interest rates near zero for nearly 25 years. So kind of that's been their permanent strategy. It appears that maybe they're backing off on that a little bit more recently, but that's been their strategy. If it costs nothing to service debt, a large debt balance doesn't matter. But it's not really possible for the U.S. to do that. The Federal Reserve's mandate is really around full employment and keeping inflation at a reasonable level, but it's not to manage interest rates. And so we don't quite have that leniency that perhaps Japan has used so aggressively over the last 25 years. Greece, their sovereign debt crisis in 2009 led to a loan by the IMF in 2010 that was conditional on austerity measures like tax increases as well as spending cuts, and we'll explore that a little bit more. But that austerity also led to riots, a lot of social unrest, and some national strikes as well. In 2011, investors actually ended up agreeing to a 50% write-down on Greek debt to just kind of reset the stage and move forward. And so after a decade, confidence has mostly been restored to Greece, but debt still remains at a pretty high level. And social unrest is frankly still an issue there. So ultimately, the question really comes to how will we solve this problem and what will we need to do?
Right. There's 3 main approaches that we can take to address this debt problem. First is we could cut interest rates, be like Japan. Problem solved.
Yeah.
Okay. Second is we could grow the economy. If the economy grew fast enough, that would solve it. And the third is austerity. If the government spent enough less money or took in higher taxes, that would solve it. All 3 of those could hypothetically, theoretically solve the problem, but there's limitations to each of them, and the government's not going to just pick one of those and go with it. It's probably going to choose a combination of the 3. So, but the first one, cutting interest rates, that's the strongest, most powerful, quickest results, because the rising interest rates, not overnight, but within a short period of time, that's what got us into this problem. If we can get interest rates down quickly, that would get us out of the problem, or at least make the problem a lot less painful. So that is the first and best solution if you want quick results. So why don't we do it? And the answer is, we have an inflation problem in our country. Inflation is running, depending on which number you look at, around 4% or so. And the Federal Reserve is not going to cut interest rates when inflation is running hot like this. So how are interest rates going to come down? You can't get them to come. They won't come down. I mean, you could go to some drastic measures such as instituting rationing, which is a consumption restriction on people, and that could conceivably throw us into a recession and bring interest rates down. But it's pretty drastic kind of stuff like that. So getting to lower interest rates is not easily done, but that's an important goal, and I think it's something we have to do if we're going to have our government be solvent over the long term. We have to be at a lower level of interest rates. And so if you think about that as an investor, how do you think about a return to lower interest rates, and how would that affect investments?
So obviously investment implications are key to how we think about managing our clients' assets. So from an investment standpoint, bringing inflation down would require the Fed to hike rates. That's certainly going to temporarily hurt bond prices like we've seen throughout 2022 and frankly much of 2023 thus far. But when inflation expectations do come down, bonds actually could become a great buy. It could also hurt stocks for a while as we continue that fight against inflation. But once it's kind of tampered down, the upside for stocks could be pretty attractive. So really the key is around inflation expectations. How quickly and how far will they come down? Those expectations will drive the market, not necessarily the trailing CPI number that we kind of anchor to each and every quarter when that's put out. So in the past, our focus has been on growing the economy. Do you think we can grow our way out of this debt problem?
Well, stimulating the economy and having a vibrant economy, that has a lot of appeal to everybody. Everyone wants a robust economy. And it would do a lot of good for the debt situation. It would increase the GDP, so the debt to GDP ratio, if that bottom number comes up, that's good. It would also increase the tax revenue. If you have more income, there's more taxes coming in. The government would like that. And it would build confidence among people, which would be a lot like the late 1990s, And so we have a chart now that shows the annual deficits trending higher as the growth rate trends lower, and that's the issue that we're facing right now. Is you can look from the 1960s to the present, our country's growth rate has been trending lower, and that has a lot to do with demographics. We're an older, an aging population. So how are you going to then stimulate growth to get us to this more vibrant economy, right? Well, there's things you can do. You can encourage competition. You can reduce the cost of business by deregulating. You can increase productivity with new technologies, and you can increase consumer demand. And it's like, okay, how do you increase consumer demand? Well, you cut interest rates. But once again, we know that the Fed does not want to cut interest rates now. So, and why not? Because of inflation. So once again, inflation's the kind of the linchpin for both the idea of cutting interest rates and the idea of growing the economy. Is you got to get past this inflation obstacle that we're facing right now. So that's the situation we're facing. But if we do get into a growth stage of the economy where we get a new burst of growth, how do you think we would be able to raise that growth?
Yeah, I mean, it kind of almost feels like an insurmountable task, right? Those are some long-term trends that seem undeniable almost at this point. But, there is some new hope for some new technologies, and certainly 2023 has really illustrated that could help stimulate that growth. So artificial intelligence has really become a very interesting technology, and I think a lot of businesses are trying to figure out how to incorporate that into their business mix. That could massively improve productivity. So there could be some great gains that come from that technological development. Robotics has actually already been a big part of how we've improved manufacturing and kind of done more with less. Quantum computing, I mean, it kind of feels like we're just scratching the surface from a quantum computing standpoint. It feels like there's more and more progress made towards that each and every year. And then finally, 3D printing is just another good example of how technology could evolve from how we've done things in the past to maybe a new way of doing things in the future. So from an investment perspective, growth would certainly be excellent for stocks. A business-friendly regulatory environment like you painted, that would be great for stocks as well. And this could be good for more risk-seeking bonds like high yield if we get more into that environment. So we've got this other final approach that frankly is not all that loved, but what would something like austerity look like as a path forward?
Right, austerity is like the last choice. You'd rather have just cut interest rates and be done, or just have a lot of growth and be done. But those things won't happen right away.
Yeah.
So, okay, austerity. What does it mean? It means raising taxes, cutting spending, things like raising the retirement age. I know we've done it once.
Yeah.
Is it going to happen again? I don't know. The last time we tried austerity was in 2011, following our U.S. credit downgrade. We had a downgrade in 2011 from S&P.
Yeah.
They took us from AAA to AA+, and that unleashed a round of austerity following that. So it's very likely, and you can hear the political conversation beginning about, where are we going to cut? How are we going to plug these holes?
Yeah.
So we're going to have some austerity of some sort. President Biden has some minor austerity steps in his 2024 budget proposal. He has tax increases for large corporations and wealthy individuals, eliminating tax subsidies for oil and gas, negotiating lower prescription drug prices. All these ideas, though, are just a small fraction of how much of the hole we need to fill to really get us on the right direction. So it's going to take a lot more austerity than that.
Yeah.
So I think we can probably be seeing some higher tax rates, maybe some new taxes coming on the table, increased tax enforcement. That one's clearly in the works, and spending cuts, or if there aren't actual cuts, caps or limits on future increases in spending. That's a more palatable way to cut spending, is to say, well, starting next year we'll spend the same amount. So I mean, you agree? I mean, what do you think about taxes also from an investment standpoint?
Yeah, so I mean, certainly it plays into the client outcomes that we're hopefully able to help drive towards. So if we do see tax changes, it's definitely going to raise the importance of around financial planning, which is paramount to what we do and how we work with our clients. It would also bring out probably more prevalence of more tax-efficient investment strategies as well, which we've definitely been exploring and kind of implementing in client accounts as well. From an investment perspective, we also need to be kind of on watch for what would those impacts have on specific asset classes. Do the proposed tax changes favor bonds versus stocks, international equities versus domestic equities? Are state taxes affected? These would all be questions that we would having to be asking ourselves. So let's kind of try to bring all of this together. Arthur, what are some things that are kind of top of mind, and what should we be watching for?
Yeah, right. Well, number one on the list is we're watching inflation, because that's a linchpin for cutting interest rates, for growing the economy. So that's like the number one. And so when you're watching inflation, what do you watch? Well, you watch indicators and things like, food and energy prices, because they tend to be leading. Energy prices feed into other prices. And so if you see energy moving, and we've seen it move up in the last few weeks, that's a big indicator. Also look at the shape of the yield curve. Is it sloping up or down? And the 30-year Treasury yield is a very important yield to watch, because that really shows people's expectations of long-term growth in inflation. And also tips real yields, that's another good one to watch. We're watching the Fed. That's critical. They may drive us into a recession, because I think they understand that to beat inflation, it needs to be done pretty quickly. And they're trying not to throw us into a recession unnecessarily, but it may be coming. So the inflation battle is pivotal. And then once inflation is beaten, then bonds can do well. But if inflation drags on, investors aren't going to be wanting to look at bonds. They're going to want to find assets that can rise with inflation.
Yeah.
So that's something else we're thinking about is, okay, what kind of assets are inflation sensitive?
Yeah.
And we're watching the president and Congress, and that's critical. Are they taking the right steps to beat inflation? Are they working hand in hand with the Fed to cut spending and encourage growth? Or are they working against the Fed by raising spending and taking anti-growth measures at the same time, which is kind of they'll trip up over each other. And just what is the quality of the leadership itself, the people and their leadership ability? Are they trying to address the long-term problem, or are they just looking for quick fixes for the immediate next election?
Yeah.
So if you step back and take a big picture view of it, how do you think this fits into the overall client portfolio construction?
Yeah, well, I think it brings us right back to kind of the basics and the foundation of the conversation that we have with our clients, and really understanding what is their unique circumstances. So number one, understanding their spending requirements. Absolutely need to understand that over both a short to even a medium-term time horizon. Time horizon also is critically important. Is this a portfolio that's built for the next 5 to 10 years, or is it built more into perpetuity and more of kind of a legacy type mindset? And then finally, what are the objectives of that specific client? So it's really kind of bringing it back to the basics of that really foundational conversation. From an investment implementation standpoint, we think global diversification is really, really important. Not having all of your eggs in one basket here in the U.S., but just be as diversified. You mentioned real asset is perhaps something that we could build into client portfolios a little bit more opportunistically. Asset class diversification, we preach about that a lot, but we see it time and time again as you hit different environments. Assets are intended to behave differently, so don't be all that surprised if one thing's working really, really well and the other's not. That's by design. And then finally, real assets. So, Arthur, this has been a really, really great discussion. Is there any other things that you would like to leave the audience with?
Well, I think the one takeaway for me has been that, in the past, investors have been able to just focus on their investments and not think about how the government, political issues, current events, how they affect investments, because the investments will always kind of work things out over time on their own. But that was long ago, and in the maybe past 10 years, we've moved into an era where we have a global financial crisis, we have a COVID crisis, and there's a bigger interplay between government and investments, and governments are stepping in more and more to protect investments, to drive certain ones up or certain ones down, and so that an investor really needs to keep one eye on their investments and one eye on the current events and the political situation. So, given that change in environment that we're in, I think I could foresee us doing more podcasts along these lines in the future.
Yeah. Well, thank you, Arthur. Really appreciate the time that you spent with the audience today. If you want to learn more, you can visit our website at arnerichmassena.com. Thank you for your time today, and thank you, Arthur, so much for joining us.